Headstart is a not-for-profit organization started back in 2007 when startup was not even a word. It started with its flagship initiative called Startup Saturday. Startup Saturday is basically a community meetup where startup founders get gather together once a month to discuss and synergize among themselves. Headstart runs various initiatives like Startup Saturday. Headstart Investor Circle is one of it. Start Investor Circle is basically a community of angel investors uh, where they help angel investors empower their knowledge and invest into startup. So far, they have made 5 investments, and it's a community of 400 angel investors and 50 plus strategic angel investors that are actually bringing beyond capital to these startups. Uh, this Investor Saturday is basically to empower the aspiring angel investors with the knowledge on how to do startup investments and uh, uh, give them information about how in this syndicate model works. Today we have with us Pushkar Singh, partner Tremis Capital. Uh, he he will talk to us on the science of startup investment. I'll quickly introduce him. He has done his bachelor's in mechanical engineering, MBA in finance and strategy from IIM Indore, master's in econometrics and quantitative economics from Norwegian School of Economics. He has served as a consultant in Knight Frank for 3.5 years, and post that he has worked as a research analyst at Kotak Mahindra. He is now partner at Tremis Capital. Tremis Capital is uh, an investment banking firm which helps startup to raise fund from 5 million to 10 million of ticket size. Now, 2 years back, Tremis Capital started this angel syndicate type of a model where they pull in few angel investors to invest in startup at a pre-seed and seed stage levels. I would like Mr. Pushkar to tell more about it.
Thanks, Pranali. Very, very nice introduction. So you exactly said what we do. I'm sure most people over here would know what an angel syndicate is, but I will just clarify because this will also come in startup investments when we are talking about assessing startup. So when a startup is raising a very early stage money from angel investors, it has two options. So you can either go to say 10, 15 angel investors, and then every investor puts in say 10 lakh rupees. So the startup raises 1, 2 crore. Now all these investors become shareholders of the startup because every investor has given money in their individual capacity. Now, this can become tiresome for founders because they have to negotiate with 20 people, explain the valuation, sign term sheet. Maybe every investor would like to do its own due diligence. So it takes a lot of time. So the new model, I won't call it very new model because it has been in existence for past 3, 4 years, both in US and India is there are 15, 20 angel investors who come together and invest as a company. So this is called a syndicate. So syndicate is a group of investors who invest together in a startup. Every syndicate usually has a syndicate manager. So the job of the syndicate manager is to find the right opportunity, speak to the right founder, assess the team. And once he or she likes the deal, they can pass on the deal to their investors, the syndicate manager. So then say if a syndicate, 20 people in a syndicate decide to invest in a startup, every person puts in 10 lakh rupees, and then the startup gets 2 crore from one entity. So because the syndicate forms a SPV, a virtual SPV, so there are mechanisms to do that in India. For example, AngelList does that, Let's Venture does that. So they create the entire structure, they create a virtual SPV. That becomes the shareholder of the startup. And all syndicate members are shareholder of the syndicate of the SPV. SPV is like a company, it's just like a company. So then startup, see the advantage of founder is you only have to sign one term sheet, you only have to negotiate with one person, you only have to update one person. So founders prefer this over having individual shareholders. They still get the same money.
So basically, it's the special purpose vehicle that is investing through its angel investors, right?
Right.
Uh, so today the topic is on the science of startup assessment. We'll start with a
Mhm.
very basic question of what are the most important factors to consider when assessing the potential success of a startup.
So most angel investors come in very early stage. So usually at that stage, either the founder has an idea or the founder is building a product, or even if the founder has launched a product, what we call an MVP, minimum viable product, the revenues are very low. So at such an early stage, what we call seed or pre-seed investing, or you can also call it post-seed sometimes, the most important thing of a startup is the founder. So you are betting on the founder or founders to create a big company. So we at Tremis, since we also invest in startups through our syndicate, the most important criterion we look at is the founder background. So say in India or all over the world, most of the startups, 95% startups are tech driven. There's a strong technology angle to it. So either they are tech platform or fintech companies or agri-tech, health tech. But technology is a key role, modern technology. So in founders, say if there are 3 or 4 founders, what we try to find out is at least there's one person who is techie, who can actually build the product they're talking about. Because product is such a core to any startup, you can't outsource that part. You can't say, all right, I'll hire an engineer, or once we raise capital, figure out we can figure out some way to build the product. The only exception is a D2C company, a direct to consumer company, where technology is not keen to the product. Most of these startups are about creating a consumer brand, and then they sell it online through Amazon, Flipkart, different marketplaces, or sometimes to their own website. So that is the only exception, in my opinion. Otherwise, the founding team should have at least one tech co-founder who can build the product. So while assessing any startup, this is what we look at. Like, how good is the founding team? By founding team, I mean founders. Like usually there'll be 3, 4 founders, sometimes two, sometimes a solo founder. Can they build what they're talking about? Do they come with the right experience? So it need not always be like you have to come from an IIT or some fancy engineering college. But say if you're talking about we want to build a fintech product, first of all, you should have a coder, someone who can actually build the product. And your team should also have relevant experience in finance. If you have worked all your life in software, say 5 years, if you have experience working with in software companies, not with banks, you just can't go in the market and say, hey, I want to build a fintech. Then you'll have to explain it. How did you find this opportunity? How did you found this opportunity of building a fintech play? What motivated you? So it becomes more difficult for a founder to raise capital. So relevant experience and tech expertise in founding team is the most important in early stages. As an investor, these are 2 things you should look at.
So, as you mentioned, the team is very important. Sometimes, what are the key
Right.
characteristics that you look in the founding team? Maybe it can be passion about the product. What what do you look particularly about the founding team uh, when you assess them?
So passion, of course, has to be there because if you're not passionate, you won't do a startup. It's a very tough business. But we also look at, like I said, relevant experience, relevant background. So you don't need to have, say, a 10, 15-year experience in a banking to build a fintech product or in technology to build a SaaS product. But you should at least have some relevant experience. And then we also try to, like, I'm talking about the team, not market or anything else. Then we also try to speak to the founders several times. And as an investor, you should also do that and try to assess why are they building this product? What makes them so keen that they are betting their career or leaving their job and trying to build something which has a high chance of not succeeding because most startups fail. So how did they find this gap in the market? So once you start doing such conversation, who are the competitors? Why do they think what are the gaps in the products of their competitors? Why do they think they can build a better product? So I would say most importantly is vision, like what the founder is building. Then comes the relevant experience. And finally, of course, passion. But that's a given. You don't become a founder if you're not passionate.
Okay. So apart from the founding team, what are the matrices that you evaluate for a startup's performance so far?
Right, right. So in very early stages, if you have not built the product or you're still building the product, there are very few metrics you can use. So in or in venture capital industry, we call them KPIs, key performance
Okay.
indicators. So these are metrics that founders or companies present them to the investor, or investors use them to evaluate a startup. To give you an example, say if you're investing in a listed company, say like something listed on Bombay Stock Exchange. So the most common metric that a lot of investors use is called price by earning ratio. That what is the price of a share and what is the earning per share of the startup. And you calculate that multiple and compare it with the industry, saying if the share is overvalued, if the share is undervalued. Then there are other metrics like return on capital, return on investment, return on capital employed, different metrics. Now, most startups, there is no earning. Even if they are making profit, there's a loss. Like most of them are burning capital because they're growing quickly. So then you can't use price by earning in startup. So then what do you use in a startup? You look at growth. So revenue is the most important metric for most startups, I would say. Even if it's an early stage or late stage, all VCs look at revenue. So how quickly is the startup growing? So for example, is the revenue becoming 2x every 3 months, or are they taking like 1 year to double the revenue? Second thing you should look at, and that has also become relevant in the post-pandemic world. I wouldn't say post-pandemic world. Last 1 year, once you might have heard of the term called winter. I don't know what's the term they're
Funding
using.
winter.
Funding winter, right? Where venture capital has dried up. So now most VCs are looking at how efficiently are you growing. So say, for example, in the earlier times, in the good old days, in 2020, 2021, like no one really cared if the startup was using 10 rupees to create a revenue of 10 rupees or 2 rupees. So if it was burning 2 rupees to add a revenue of 10 rupees, or it was burning 10 rupees, as long as 10 rupees revenue was being added, everything was fine. But now in today's scenario, and as an angel investor also, the most critical metric you should look at is how efficiently startup is using capital to grow. So to give an example, assuming there are two SaaS startups. Now everything is same, the team, the market, the product, they are broadly comparable. But one startup has used, say, $1 million to get to a revenue of $1 million, while the other startup has used $500,000 to get to the revenue of $1 million. Same revenue, but the amount of money they have used to build the product and reach that revenue is different. So the startup that has used lower cash, like that has burned lower money, is more efficient. And you should back that, because that's an indicator that these founders are better at using capital. So going forward also, to scale up the company, they would need fewer capital, lower capital than the other guys.
Correct. Now, majorly these kind of an angel investment gets in uh, exit through maybe strategic investor buying out their shares, or something, a bigger VC buying out their shares. So market becomes an important aspect where you look at when you are investing into a early stage seed stage startup, right? So how do you assess it at that time when there is no market at all, maybe because it's an innovation which they have brought, or if there is an existing market, how do you look at it?
So most startups are trying to disrupt an existing industry. Very few. So the example that gets thrown most often is something like Amazon. So when
Correct.
Amazon came in, there was no market for online books, delivery of online books.
Correct.
But people were still reading books, right? It wasn't that Amazon was trying to sell books and no one knew what books was. They were just trying to sell it through a different medium.
Correct.
So it's the same. You can take the same analogy for all startups. So all startups are trying to disrupt an existing industry. Now, how big is that industry? Say if there's a startup that is doing something very localized. So of course you will know the market can't be big enough because some if they want to sell a product that is very niche, you find some startup in India who says, all right, we want to sell a maybe like a vegan ice cream. Just to give an example, something like that. Now, ice cream market is big in India, but the vegan ice cream market is still small. So if you want to invest in that startup, you should also try to read a bit more about the vegan habits of Indians. How many people are becoming vegan? Is it an increasing trend? How big is how have vegan market evolved in different countries like US, Europe, more developed country where veganism is more common? And if you look at startups deck, they always give you a TAM saying that total addressable market is this much. So when you're speaking to founder, you should try to understand how did they arrive at that total addressable market? What was their methodology? So I think maybe some startup will say our TAM is 100 billion dollars. Some will say it's 10 billion. Some will say it's 1 billion. It doesn't matter because $1 billion TAM is big enough. Like anyways, your startup is never going to become a $1 billion company, $1 billion revenue. That's very, very far-fetched. So you can never capture the whole market. So it doesn't matter if the TAM is say 100 billion or 1 billion, but it should not be very small. Like if I'm a founder and if I'm building something and the total revenue potential of that product is only $5 million or $10 million. Maybe that's not a great product to back because then unless that market is growing really quickly, if you can go in the past data and see that market has been doubling every year, it's likely to stay a niche market. So how to assess market is do your secondary research, try to read reports, what they're saying, and also speak to founder to understand what exactly is their market. What is the market they are targeting?
I think fantastic. And you talk one thing about the burn rate. I mean, the one who is
Mhm.
actually investing less and earning more is the one who will succeed in the longer term. So that shows that there should be a sustainable competitive advantage in a company. How do you
Mhm.
assess that the company is actually having a sustainable competitive advantage or not?
So very interesting question because like we often think on these lines saying, hey, we are investing in a company. Do they have a long-term competitive advantage? So the word that gets thrown around in the venture capital industry is called moat. You might hear something people saying, what is a moat? Like
More.
founders
Yeah.
often get asked, like, what is? So moat just means competitive advantage. So at such an early stage, it's extremely difficult to find if the startup has a competitive advantage or not. So one competitive advantage can be scale, growth. That if you're an early entrant in the market and you grew quickly, you have created a brand, and then others will find it difficult to catch up. But for us, like since we invest in very early stages, we don't get to see big startups. So for us, moat is about the founding team. What is their vision? Because see, unlike a listed company where the business are set or big company where everything is in order, you are just trying to grow not so quickly, maybe 10, 15% every year. You have a big team. In early stage startups, everything's around the founder. So the founder has to build a competitive advantage. It can either be through its brand, through its network, through its technology. So if you're backing, so our thesis at Tremis is very simple. We want to back exceptional founders. Why? Because say if we back some founder whom we think are great at what they're building, and even if what they're building doesn't turn out to be amazing in 1 year, these people are smart enough to pivot and build something else. So as a startup, you always have to keep pivoting, keep refining your product, you launch a product, you say launch a MVP, you take feedback from the market, you iterate, you repeat that process, keep doing. Smart founders do that and they do it quickly. That can become a competitive advantage. So the founding team is the biggest competitive advantage in early stages rather than the product or the market or what is the idea.
Got it. And what are the key steps that are involved in the due diligence process while assessing a potential investment? So once you have liked the idea,
Mhm.
You are about to commit it. Now the process start of engaging with them on due diligence process. So what are the key steps involved in conducting that due diligence?
So in very early stages, uh, you have to think about due diligence. How did due diligence term came in? So venture capital is a very trust-based industry. So it might change in the future because we are seeing a lot of frauds in early stage and late stage companies. But so far the trend has been if the founder is saying something, we as investors believe them. So if the founder said, all right, my revenue was in last month 20 lakh rupees, they send you an Excel sheet. It's called an MIS, saying this has been my revenue growth on month. You usually believe it. You're saying, all right, he's not lying. But larger VCs or angel syndicates, see, as an angel investor, for you, it's very tough to conduct your own due diligence. You don't have so much time. You also have a most probably full-time job or a business. You can't spend hours conducting due diligence trying to understand if the founder is claiming a revenue of 20 lakhs, that revenue is correct through bank account statement. If the founder is saying my expenses are 50 lakhs, that is also correct. The money is going in the right hand. It's not that he's just taking out money, giving it to friend or a vendor. So these things can also happen. So as an angel investor, my advice to most of them is unless you are a full-time angel investor and you're very hands-on, you invest with a larger VC or through a syndicate. You always co-invest because there the advantage is the VC will have some legal firm, some accounting firm to conduct the due diligence. If the first of all, so due diligence can be two types. One is legal, the second is financial. The legal part is the company is legit, all the filings has been done, there is no filing that is missing, shareholders table has been updated. So these are the things that a lawyer does and a VC always checks. Financial is if I am claiming certain revenue, if I am claiming certain expense, they are correct. There is a paper trail for it. So angel investors will find it difficult to do it, but most VCs outsource it to a law firm or an accounting firm to conduct the DD. Still, you'll see a lot of frauds happening, not only in India and all over the world, where VCs invested hundreds of millions of dollars without doing any due diligence. So after DD comes the second stage, where you usually take a board seat, either in a supervisory position or a normal board seat, where you keep a tap on whatever the money has come in, it's going in the right direction, it's going in building products. So again, as an angel investor, you can't do that. So you rely on the VCs to do that, who are the other investors in the round. But if you like the founder, if you think the background is correct, you should. So as an angel investor, what you can do is do some background check on the founder. Try to speak to his earlier colleagues or his friends, or if it comes to a family, of course, you know him well. Because if the founder's intent is clear, you don't really need to do a lot of dealing. It's very unlikely that there'll be some fraud or the founder will take out money. So again, I keep coming back to founder because in a startup, everything is revolves around the founder. You can only put certain checks and balances. But if the founder is dishonest, and that also happens sometimes, there is nothing you can do. Your money is gone.
Maybe founder is dishonest is one of the red flags that you see while your due diligence process. What are the other red flags that can be visible with the help of this due diligence process? Why it is so important to have it?
So when you conduct a due diligence process, you again, like I said, so see, there could be some missing things. For example, the founder of the company hasn't done the right filing. They were not aware of that once you raise the capital, you have to do this filing or you have to update it. So that can be easily solved. That's not a challenge on the legal side, on the company side. So first of all, as a investor, you should analyze is if the company is legitimate. It's not that the company itself is fake. So if there's an existence in ROC, the right records have been updated, right? The company has been conducting regular board meetings, filing regular filings. So that gives you a sense that all right, the company I'm buying a share is legitimate. So if something is wrong on that front, that's a big red flag. So then you should speak to the founder. And in most cases, founder don't know. And that's where a lot of value early stage VCs add. Because then they can advise founder like, hey, this filing is missing or something else is wrong. They'll give them legal support or the founder can ask their own lawyer or CA to just clear it. The other red flag, in my opinion, the biggest red flag that can happen in such an early stages, say if the founder is claiming 20 lakh revenues and the money is not coming in its bank account. So the company's bank account, the last month revenue, if you say my last month revenue was 10 lakhs and only 2 lakh rupees came. And what it means is either the founder is lying or he's very aggressive about his revenue estimation. He's just claiming future revenue in today. He expects the revenue to come in 5 months and he's just booking it right now. Same with expense. If in a certain month you all of a sudden see a lot of more money going to a suspicious bank account, all of a sudden some expense like 25, 30 lakhs went to some bank account, you don't know what it is. So these are the things you should question founder. Sometimes there's a legitimate reason, sometimes it could be a fraud.
So when you were talking about this 2 lakh versus 20 lakh things, one question that came into my mind is, uh, whenever a startup is, presenting their future projections, etc., that's the key part when we consider it in our assessment, in assessing the startup. So how to see that projections and how to, sometimes actually uh, uh, validate them in terms of whether they are achievable or not, whether they are realistic or not.
Right, right. So this is something as an angel investor very tough to do unless you understand the industry really well.
Really.
See, because if I create a company, say a prop tech company like what we were talking about, and I say I need $1 million to achieve a revenue of $5 million. And these are my projections on Excel. Now, if my invest and you are the investor, now if you don't understand the prop tech industry, like it's impossible for you to validate those assumptions. So of course, projections are important. They should also look realistic, but the definition of realistic, optimistic, pessimistic, you can only assess that if you have the right experience. So if you're an angel investor early in your stage of angel investment journey, or if you have made a few investment, one good thing would be you try developing one sector expertise. For example, you say, all right, I become an expertise in finance, fintech sector. You study different fintech models, try to assess, all right, how quickly companies have grown, how much money have they taken to grow that. If I'm claiming like I need $1 million to reach a revenue of 10 million, while everyone else has burned $7 million, it's not realistic. But for you to tell that, you need to have that reference point. And say they are a group of 10, 15 investors. Everyone develops expertise in one field. Then you can compare notes. You can compare together. You can invest together and say, all right, there's a fintech deal. I can evaluate that. If there's a agri-tech or a whatever SaaS deal, D2C deal, you can evaluate that. That is the only way to know if the financial projections are realistic or not. Otherwise, there is no book or rule of thumb saying, all right, you can't, this looks realistic or this looks aggressive. It's very tough.
So before we open the questions to everyone, I would like to ask, what are the common mistakes that an angel investor will be doing while assessing a startup, while investing into a startup, and how they can be avoided? Maybe you can share your example that you have done so far in your journey, in your career.
So the most common mistake so there are multiple mistakes that investors can do after investing in a startup. So one thing is a lot of angel investors in early stages try to micromanage the founder, telling them, hey, this is how you should run the business. And this usually happens when an angel investor has some prior experience in that industry. But then you should realize that the founder has to run the company. He has to build the company. As an investor, you can't do anything. If you're micromanaging, you're just wasting your time, his time. But at the time of assessment, a lot of angel investors get swayed by, say, the market size, what they are building. Like, all right, if there's a big market, it can become like there's $100 billion market. I'm betting on a unicorn. Now, that is, of course, you can't make a unicorn in a $10 million market. The market has to be big enough. But that is just one criterion. Most angel investors, in my opinion, don't try to understand the founder. You really have to, assessing a startup, you also have to assess the founder. Speak to them, try to understand their motivation, why they are building this. If they're claiming certain numbers, how realistic they are, why, Like why the founder says I can grow by 3x in this year. What is his product vision? So you have to spend more time on founder, trying to understand founder's vision, do some background check of the founder. If you have known founder for a long time, that's fine. Like if you're investing in a friend's company, you have known that person for a long time. That is all right. But if you're investing in a stranger's company, so these are things like you have to be very hands-on on the founder, what they are building, what is their background, what is their vision, because there is not much you can do in a startup. There is no data in early stages to say, all right, the revenue has been growing for 5 years at 20%, so this seems like a good deal. There's unlike a listed company, you lack data. So you have to go by your gut feel. And to develop that gut feel, you have to understand the industry and the founder.
Maybe Pushkar, you can share a few examples that you have, you know, uh, come across that this was a mistake, or maybe you just missed it doing a mistake. Maybe something if you can
So,
share.
so I can't, of course, mention the names,
Sure.
but in the past, we have been, I would say, see, these things come with an hindsight. Like if you were so smart at the start, you wouldn't have made that mistake.
Correct.
It's just that things have panned out and now you realize, but maybe something else. We didn't do that at the start.
Correct.
So when we started investing and we were also learning, a lot of times we also thought, so our investment, for that, I'll have to explain you Tremis's investment thesis. So our investment thesis is we only co-invest. We never lead the round. So the rationale is we are a small team. We lack the expertise to conduct a detailed due diligence. So if there's a big VC who are investing 2 million in a startup, we can put in our $200,000, which is fine. We always outsource the due diligence to VC. Now, sometimes it can lead to fraud. Sometimes because VCs are also so busy, and especially in times when capital was plenty, no one was conducting due diligence. So now we have realized that going forward, we should also conduct, of course, we can't conduct a very thorough due diligence like a lead investor. So we still want a lead investor in place, but maybe we would like to evaluate the bank account statement, something we should have done for all our companies in the past. We didn't do that, which is fine. But this is how you learn. Or maybe we should have taken a lot of founder checks, founder referral. So everything that I am telling you, like you should speak to the founder, do a lot of founder ref check, has come from the experience.
Okay.
Once we have realized that, all right, this company is not doing as well as we thought it should. So we invested in some startup and we expected the revenue to grow by 3 times in 1 year or 2 years, 5 times in 2 years. But the revenue growth has stalled. And then we try to figure out like why it's not growing, because we didn't like do a lot of founder check and understanding, can founders build this product? So we just betted on a good story on smart founders, but maybe the founders didn't have the capability to build this product. So this is something you'll only learn. So again, I'm telling you, as an investor, 99% of the startup is around the founder in early stages. You have to like the founder, you have to like what they are building. It has to be exciting, and then you have to do a lot of your checks, founder checks.
Also, how is the chemistry of yours with the founder? So chemistry is also an important factor when you invest, whether you match the vision or not. One thing that I would also like to ask is, how has the pandemic impacted the way startups are assessed? And what are the key trends that have emerged as a result of that?
So before pandemic, again, venture capital was still plenty. But what happened in 2021 was all central banks printed a lot of money all over the world, US, Europe, Japan, India. So all of a sudden, a lot of money came in the market. And that started going into startups. A big portion of that, VC started investing it into startups. So the biggest impact of pandemic on the startup was suddenly we started seeing very high valuations. So see, in a mid-stage startup, the most common metric to value a startup is growth multiple, revenue multiple. Like as I said, in a listed company, it's priced by earning. In a startup, it's priced by revenue, hence there is no earning. So say in SaaS, if the trend was that the revenue is annual revenue, say is $1 million, or say $10 million, we can give them a 5x valuation. So the company is worth $50 million at $10 million revenue. Now there was so much money supply in the pandemic that these revenue multiples became 20x. So suddenly a startup in pre-pandemic phase that would have got a valuation of 50 million was getting a valuation of 200 million, 250 million, because money was in plenty. So then we saw, now that again has come down because of funding winter, like the money is no longer so superfluous. But how pandemic changed what people, I would say, if you had to ask me one thing that the pandemic changed in the world, people started realizing that eventually software will trump everything. So there is a very famous VC in US, Mark Anderson, who said software is going to eat the world. What he meant was in 10, 20 years, everything will be around software. Pandemic accelerated that trend. So before pandemic, of course, software was important, but most of us had to go to office to work. We realized like, all right, going to office is critical. You can't work remote. Some people were still working remote, but that mindset has changed. And then now that's why now you're seeing a lot of startups that like who are just capitalizing on this trend that you don't need to be physically present at a place. You will see a lot of startups around AI, a lot of startups around content, video streaming, SaaS, where you don't really have to have a physical vendor. You don't have to do everything physically. You can do everything online. So it accelerated that trend. So anyways, online was becoming more and more predominant, like e-commerce. People were buying more groceries. The trend was increasing. The pandemic just accelerated that trend, made it much more powerful.
I think I tried to cover all the questions all around startup assessment. I would now like to open it for all to ask questions to Pushkar, if any.
Hi, can I please pose my question?
Yes, please.
Hello, Pushkar. First of all, thank you for taking time out for this. This has been incredibly helpful. But coming from an early stage angel investor, like you very rightly pointed out, that it all boils down to the founder and the understanding of the industry and the ecosystem. So for that, I would like to understand, what is your knowledge resource? So I have been reading your posts on LinkedIn and I find them very helpful. And if I know as a startup, a new angel investor, that what should be my source of knowledge resource to understand those industries that I'm looking to invest in, that will help me better assess the founder and where he's coming from, and assess the projections, etc.
If you want to understand how founders think, what are the things you should look at in founders? Paul Graham, like the founder of Y Combinator, he writes a lot of essays on his blog. If you just search Paul Graham, Y Combinator or Paul Graham blog, you'll find his blog. So he has written very detailed essays on like why do people create startups? How do founders think? So that has shaped my vision a lot. I've read a lot of Paul Graham blogs, Paul Graham essays, and trust me, they're all excellent. So you should definitely read that. The second thing, what you should also read is, so see, there are a lot of VCs who are specific to marketplaces, who are specific to sectors. So for example, say if you are interested in marketplaces, evaluating market. So first thing you should realize is, if this is not what you do for a full-time job, you can't become an expert in everything. You have to pick one or two sectors.
Precisely.
So there is a guy called Fabrice Grinda, founder of a VC firm called FJ Labs. He also was the founder of the OLX, the startup. He writes a lot on online marketplaces. That what are online marketplaces trends? How do they evaluate the deal? What are the KPIs, parameters they look at? So his blog is also a great resource for understanding marketplaces. And then maybe I suggest you can read, there are dozens of great books. Maybe just read one or two books on the entire life cycle of a startup. Like how does the startup go out in the market to raise capital? What are the different due diligence process? How do they arrive at valuation? What are negotiation? So that will give you a flavor of understanding the life cycle, like why do startups raise capital? How do they grow? What are the documents you have to sign? So because those things don't usually change, they remain broadly same. So,
Right.
but you'll have to pick one or two sector and then develop your expertise. Two things if I would recommend is Paul Graham's blog. and Fabrice Grinda's blog. These two write really well.
All right. One more thing. So when we are looking at the term sheet, we somehow, end up thinking of protecting ourselves first. But ultimately, I've seen that kind of hinders the founder in the next round if the term sheet terms are not founder friendly. So what, in your experience, is the most important terms in a term sheet, which, we can find a way which works for both the investor and the founder, and we can make it founder friendly?
So excellent question. So a lot of angel investors go wrong on that. See, first of all, a lot of angels investors try to invest small amount and get a really large share of the company. They think I'm investing, say, 50 lakhs. I want 25% of the company. Now, what they don't realize is that every round the founder raises, like the founder gets diluted. By dilution, I mean his percentage stake comes down into the company. So if after 2 or 3 rounds, he doesn't have a lot of stake left in the company, he doesn't have a motivation to run the company. There's no skin in the game. And late stage VCs realize that. So they don't invest in such companies. So anyways, like you might have 20% in a company that's worthless because that company will never become big or sell to another company, get acquired or go for an IPO. You would rather have small share in a big company than having 20% or 50% in a really small company. That's also true for founders. A lot of founders are also very, I would say, adamant about dilution, that I don't want to dilute more than 10%. I only want to dilute 5%. But then founders should also have to realize that they need money to grow. If they can't raise capital, they can't grow. Their 100% is useless. So this is one thing you should look at, like what is the right dilution? And others, see, as an early stage investor, the only clauses you should be worried about is, for example, you have a liquidation. If the company gets acquired, you also make your money. Or say, for example, there are a lot of fancy clauses in a startup term sheet, something like drag along, where you have a drag along right. If you want to sell the company to someone, you can drag along the majority shareholders. You don't need such rights because that's useless. You're never going to do that as a small angel investor. What you should ask for is maybe like one important thing we always ask for is information right. That means every month the founder sends you information saying, this is how the company is going. So at least you have an idea that how your investment is heading, where did you invest? And second, maybe you can also ask for a pro rata right. That if you invest in 10 companies, you get pro rata to maintain your ownership in the next round, whenever the founder raises capital in the next round. So if you have done investment in 10 companies, not all 10 will do well. Maybe only 2 or 3 will do well. But at least in those 2 or 3, you have an option of investing more capital. This is what VCs call backing the winners, so that at least you make more money at a portfolio level. And the most common instrument to raise capital right now in India are safe notes, like Y Combinator started it, safe note, which are very founder friendly. So if a founder is using a safe note, like all the terms are quite friendly, so you should not be unduly bothered about it.
Thank you so much. That is really helpful.
Pushkar, Nimisha is asking, how can we tap these startups from investment perspective? By the time we see them online, they're probably ahead of pre-seed or seed round. So maybe she is asking about what all are the platforms where they can find good startups to invest in.
So most startups in India like when they're raising their first round. So see, first of all, if you are a celebrated founder, someone like say Kunal Shah, now you already have built 2-3 unicorns. So the moment you say I'm doing a new startup, like some VC will write you $10 million check. As an angel investor, you can't invest in those startups. You'll never have the opportunity. Where you can invest is first-time founders who are raising capital. Most of these founders go through websites like AngelList or Let's Venture. So what happens is all founders now are becoming more averse of raising, say, very small checks from angel investors. What they want is 10, 15 angel investors come and invest a slightly larger amount. So what angel syndicates do. So if you want to invest in more startups, the right way approach could be you register yourself on AngelList India, which is the largest platform. And then AngelList India will have dozens of syndicates. So then try and see what syndicate you like, whose investment thesis you like, because every syndicate, some syndicate are sector specific, some have a minimum check size. In some syndicate, you say, all right, you can only invest 5 lakh rupees in every deal. Somewhere you can invest 1 lakh. So find the right syndicate for you. That is the easiest way of getting a good deal flow. Because then syndicate managers are very well connected people. They go out in the market, they keep speaking to the founders. So they do the heavy lifting for you.
Thank you, Pushkar. That really answers the question.
You're welcome.
So till the time anyone has question, I think I covered about assessment. We had some chat about terms also. Anything you can talk about on exit? I mean, what are the sources and how can, at what stage we should seek an exit? Wait or wait or share, wait or sell. Everything you can, talk about it.
So as an angel investor, you don't have a lot of say about exit. Say you invested in 10 startups, only 2 did well. And they went on to raise the next rounds. Say, let's say they went on to raise their Series A, Series B. So by the time a startup is raising its Series B or Series C, I would say like a $10 million round, could be Series B also, or Series A plus, like the nomenclature can be very confusing. What happens is by that time, the founder already has diluted a bit of a large part of his stake. Now I am a VC. I want to invest $10 million in a company. And I want 20% of the stake in that startup because that is my investment thesis. But say the founder only wants to sell 5% or 10%. So what the founder does is he talks to early stage investors and say, hey, you invested at say $1 million valuation or say $5 million valuation. Now the company valuation is 50 million. Why don't you take an exit? There's a new investor coming in. Why don't you sell your share to this new investor so that I also don't have to dilute much? Because the company doesn't need so much money right now to grow. But the investor has a requirement of having at least 20% of the company. That is part of his fund thesis. So then you get an exit. So this is called secondary. So in startup, in early stages, the startup is always issuing new shares. Those are called primary shares. So as a founder, I'm not selling my share. I am selling new share to the investor. That money is coming to the startup. As the startup becomes slightly bigger, you start seeing both primary and secondary. Primary is the startup issuing new share, new investor coming in. That money comes into the startup. Secondary is an existing investor sells their shares to the new investor, like how we see on the stock market. So an IPO is a primary, where the company is issuing new shares, and day-to-day transactions are secondary, where I am selling my share, you're buying my share. So as an angel investor, it's very unlikely that you'll stay till the IPO or till the startup becomes a $10 billion company. Most likely, it will either get acquired before that and you get your money if a new company acquires the startup, or if the startup raises a big round, a $10-20 million round, and then the founder asks all its early stage investors to sell the share. Now, the founder can't force you, of course. You are a shareholder, you have a right, you say, no, I don't want to sell it. But most people do, because by that time, if the company has done well, they already have made 15-20x return on the investment. They are fine with it. It also gives them a good name. These kind of angel founders prefer such angel investors who are founder friendly. When the founder says, all right, no founder will ask you to sell at say 2x or 3x, because founders also realize that's not lucrative enough. But if you invested 10 lakhs and in 2-3 years, that 10 lakhs is now worth a crore. That's a good return in a startup in 2-3 years. So then you should sell. So this is the most common form of exit in India.
Yes, Arnab. I think Arnab has a question. Please go ahead.
Hi, Pushkar. I'm Arnab Guha from Impeccable Innovations, Bangalore. It was a very engaging talks, and I've taken a note of all your talks today. So I just wanted to ask you, if there is a startup like ours, which is into food as a medicine space, means it's not just only a tasty food, and it is not a pharma medicine, but it is giving a lot of impact in the disease and disorder segments. And our brand is a 4-year-old. So for a startup like us, where we don't have enough money to do a clinical trial on 200 patients and to prove the things, but we have a lot of anecdotal evidence of people get improved in their medical conditions or so. And also we also are getting an attraction from a listed company from Thailand into this ingredient space, but not into our type of specialized food. And so how to maximize this situation that we are in, where we have almost created a molecule, let's say our cocktail of formulation, which is working well, and how to do the investors and how to make them believe that like a pharma molecule takes 10 years or 8 years to get launched into the market for a particular disease. R is actually working, and if we can get the network of investors and all, it will just fly. So almost like for 4 years, we have been working hard, especially to get the strategy right, get the product right. We are already selling in the market. We have sold more than 3 tons of our product through online and Flipkart and through our website. Now we know what it works, which disease it works. And so I hope you understand my question. We are in a stage where we need to play the game in a very interesting way.
So honestly, I'm not an expert of clinical trials. How long does it take to launch a product and then to get the right clinical trials? My understanding is it can take years before you're able to say, all right, this is the medicine I want to launch. If you want to launch a chemical compound. So the investor, the Thai company that has shown interest, what you should be talking to them about, all right, we can take your investment, but tell us how can we expedite this process? Because as a startup, maybe you don't have 10 years. You can't just go through the regular clinical trial way.
Yeah.
So is there any, so in an investor, what you should be looking at right now at your stages, not only money, but outside, because yours is a very niche product. It's a very complicated, it's not like a regular D2C brand that is saying we are selling healthy food. You're not selling healthy food. You said you have concocted some compounds that have a medicinal benefit on it.
It's
now,
a food.
Of course,
it's a food. It's not a molecule. Means it's a cocktail of certain ingredients. Our brand is Spotify, and currently, sir.
But see, most of the evidence is anecdotal, right? Right now, you haven't gone the clinical trial way.
Yeah.
So with all your investors, you should say, hey guys, there's something we have built. There's a lot of anecdotal evidence that it works. Now, before we can really market it as a medicine, we need to have whatever is the process, clinical trial. How can you help us with that? Do you have the network of right labs? Do you have the network of right doctors who can quickly do it? Because see, even if you raise capital right now, some VC writes you a $2-3 million check, you won't be able to do it by yourself.
No.
You have created the product, but you need an expertise of a larger company now to help you take it to the next stage.
Yeah.
So, and if you sell a minority stake to a large company, that's fine, because eventually you'll also be able to use their network.
Okay.
Their selling network, their distribution network. So it can be depending upon what is your vision. Do you want to continue with this company for 10 years, or you find saying, all right, we sell a stake to a company and eventually we sell out the entire company to that bigger company. So it will boil down to that. But look for a strategic investor in your case. I usually don't recommend it, but yours is a complicated product.
Yeah.
A regular VC won't be able to add a lot of value to it. You need to figure out a way to expedite this process.
Correct. So we have seen certain government look out for us also. Government is also starting getting interested, because a large part of our technology is millet based. So, and this being a international year of millet, we got a grant from central government.
If you don't mind, Arnab, I think I can connect you guys offline.
Okay, fine.
We will try to stick it to the topic, and so that maximum people can get benefit of it. Yeah.
Sure. But thanks for the chance to talk.
Thank you, Arnab. Yeah. So Kenil is asking, what is the optimal trade-off between evaluating a startup's product/services offering versus business potential as a part of due diligence?
Wow, that's a complicated question to answer. So sorry, can you repeat it one more time? I didn't understand it well.
Yeah.
Trade-off between.
So trade-off between evaluating a startup's products or service offering versus
Mhm.
business potential as a part of due diligence.
Yes, sir. So any startup you decide to invest in, you of course have to assess the startup, understand the product, what they're building, how big is the market. So this is something you really have to do. Now, in early stages, due diligence, you should not say, all right, I'll conduct a very thorough due diligence, or I'll conduct something which is like I'll ask for dozens of data. I'll just try to, because the founder won't have it. So when you talk about trade-off, I think assessment comes first. You find the right startup. You try to see, all right, it fits whatever checks you have. And in due diligence, try to look for red flags. You say, all right, these are 5 things I'm not comfortable with. If the founder is claiming a revenue of 20 lakhs, if the 20 lakhs is coming, I'm fine with it. So think of due diligence as saying, these are 5 non-negotiable things. I only need to find out these 5. If these 5 are fine, I am investing because I like the product. You should not say, I'll assess a startup and then I'll conduct a very thorough due diligence to figure out how big is the market potential, or who are the competitors, or what is their trade secret, because that's a waste of time. You'll never get to do that. So you should focus more on assessment, trying to find out the right startup, right founder, and then have these 4 or 5 things on due diligence saying, these are non-negotiables for me.
So I think a nice session, Pushkar. I'll like to conclude it. Pushkar talked all about how to assess a startup, and he gave 90%, more than 90% weightage to a founding, to the strength of founding team. We also talked about term sheets in a very small portion, and then all about exit also. So thanks for coming, Pushkar. We glad we had you. I think all these angels would probably be starting their startup assessments with your guidance now.
All right then. Bye-bye.